retirement planning is intricate, but here's the thing. If you go and you talk to a contractor, and let's just say you show up to your site where your house is being built and you talk to the subcontractor who's pouring the foundation, he's going to start talking about horizontal integration, vertical integration. How do you get all of this to work together to make sure your electrical can run through the foundation? And he's going to be talking about all these things. But at the end of the day, you have to look at this person and say, can I trust them? And as long as you can, then you can see how at least in our world, how your money is growing more and why you're taking less risk. And the reason why I love building a plan like this, that takes the best of both worlds. You take the best of the stock market, you take the best of insurance products, you commingle them together, and you create a plan that you don't have constant anxiety. Welcome to the show. This is the Build Big, Live Bigger podcast. This is where you get real clarity about retirement so you can build a plan that blesses your life instead of becoming it. We'll share what you need to hear to replace worry with confidence, protect what you've built, and actually live your dreams, not your fears in retirement. Let's dive in. All right, welcome to episode 16 of the Build Big, Live Bigger podcast. I'm your host today, Johnathan Burgess, the owner and founder of Big Money Retirement Solutions. And you picked a great episode to listen to today because we are actually going to give you real strategies and tactics behind how we create retirement plans for our clients. So I'm actually going to be taking somebody who came in as a prospective client 3 weeks ago. We've redacted all of their information. And we are going to show you how to create a retirement plan where you can live your dreams, not your worries. And we've done this over 700 times, and we managed $300 million or a little bit over $300 million in total assets for clients who are 50 and older. So we do this day in and day out. And I wanted to give you some tactics today that you could potentially implement. Now, I do have to say this is not a recommendation to buy or sell security. This is for informational purposes only. I'm also not going to show you the big money portfolios. We're just going to talk about our philosophies around index funds, and I am going to create a portfolio on the fly. But the portfolio that I create, this is not a recommendation for you to go out and buy those securities. So I do have to say that on the front end. So we're going to use a redacted client. We're going to call them Jim and Sally. So Jim and Sally came into our office and they had the same general worries that most people do. Can I retire? Am I going to run out of money? Where should I pull money from? How much am I going to pay in taxes in my retirement, etc. They had a Mod Podge of retirement accounts. There were 3 total accounts: a traditional IRA, a Roth IRA, and a brokerage account. They are 65 years old. That's the average age of the household. Jim's a little bit older. Sally's a little bit younger, but 65 is the average age of the household. So we're going to take a deep dive today. We're actually going to look at their portfolio, the client's name. Their name is not Jim and Sally. I'm just telling you a fake name. But we are going to look at Jim and Sally, and I'm going to show you generally what I would do for these people so that you can have takeaways and real tactics. But again, this is not a recommendation. I have to say that multiple times. So Jim and Sally, the first thing we want to do whenever we're looking at their portfolio, and I've got it pulled up here in our analytics software, they've got $1,436,664. So great savers. Their goal is to be able to take $60,000 a year out of their portfolios, and they don't want to have to worry about running out of money. So the first thing that we need to do is we need to look at a very common rule between most certified financial planners. One of the highest accreditations you can have is following something called prudent investor rule. Now, what is prudent investor rule? It is your asset allocation. So what percentage of your assets should you have that are safe? What percentage of your assets should you have that are tied to market-based vehicles and things that could temporarily go down in value? So I told you that their average age was 65. So this is simple. So we're going to use 2 buckets here. And we're going to have 65% of their assets on one side because that's their age. So if you're doing this and you're listening at home, just think, okay, I need my age on one side. The other side is the difference. So it'd be 35%. Now this is safe, whatever their age is. So 65% of their money should be safe. 35% should be allocated to the market, and that's for growth. Okay. So that's the first thing. So let's look and see if Jim and Sally are following prudent investor rule. Now, why do they need to follow this rule? Well, the reason they need to follow it is because their goal is a little bit over 4% of their portfolio is what they need each year to live off of. So they're kind of pushing it. You really shouldn't draw any more than 4% of your portfolio if you want to make sure your money lasts your whole life. But there are some things that you can do to potentially increase that slightly. Would never go above 5 or 6%. So we're going to go back here. So 65% of the money needs to be safe. So before we look at what they're doing now, they should have $910,000 that is safe. We're going to look and see how much they have that's safe. Okay, growth, they should have $490,000 in the stock market. So that's where they should be. Now let's look and see what Jim and Sally are doing before they met us. So we're going to go in here. We're going to click allocation. And Jim and Sally currently, I'm going to write what they're doing right now in red. They actually have this flip-flopped. They current, so I'm just going to write current right here. Currently have 72% in the stock market and 28% in safe money. So this is out of whack. Now, why is it out of whack? Because there is something, why is this a risk? I'm going to write this here in the middle. There's something called sequence of returns risk. Now, what sequence of returns risk is when you retire, that totally dictates the outcome of your retirement. So sequence of returns. Someone who retired in 2008 is going to have a lot worse of a retirement with this allocation than somebody who retired last year. And the thing is, we tend to have biases around, how the economy is doing now, and we think it's going to do that forever. But this 72% that's in the stock market, if the stock market drops by 50%, that's a huge problem. So the reason why we say so much money needs to be safe is if you keep it safe, you don't have to worry about losing money. It's not about how much money you make. It's about how much money you keep. And if they're so close to their goal of $60,000 and they've saved a fair amount of money, there's no reason why we need to go and risk it for the biscuit. Okay. You can generally, you don't have to go for it. You'd be fine making, they need a little bit over 4%. So really they need to be making 7.5% because inflation's at 3%. So they need to be able to take out the money that they need every year, and their principal needs to be keeping up with inflation. Simple, right? I would argue they really should be making closer to 8, but this generally is a problem in what they're doing right now. The second thing is the only two things in your control are fees and risk. So I'm going to show you how we're going to address both of those things for Jim and Sally. So how are we going to limit the amount that they're paying in fees and limit the risk that they are taking? So let's look at their portfolio. I've got it pulled up on the screen, and for my listeners, I'm going to verbally explain what we're looking at. So they've got 1.4 million right now. Jim and Sally do, the majority of the accounts were in Jim's name. So in Jim's IRA, he's got $618,192 in a Health Sciences T. Rowe Price mutual fund. Now, this is not a knock on T. Rowe Price. So someone from T. Rowe Price, if you're listening to this, I'm not knocking you. I am knocking the fees though. But if we go in and we look at this, the expenses that they're paying on this one fund, and you can do this if you're listening right now. How do you know if you own a mutual fund? It's very simple. You go through your statements, and if you have anything in your portfolio that ends in an X, generally it's a mutual fund. So how do I know that this T. Rowe Price fund is a mutual fund? It ends in X, so it's THISX. Okay, so that's the first red flag. And what we're going to do is we're going to bop over to personalfund.com. So personalfund.com is something that you can use. You can create a free online account, and you can run a report on up to 10 mutual funds. And what it's going to do is it's going to show you the actual cost of ownership of that fund over a year. And it's going to compare it to other funds that produce similar returns while not paying that same amount of money in fees. So most people know that mutual funds are expensive. Well, in this case, Jim had a very expensive one. The actual cost of ownership last year was 2.43%, which is $15,057 in mutual fund costs. That is outrageous. Now, the thing is, whenever you go in and you click into the expenses, like if I just pull up this T. Rowe Price fund, the published expenses are 0.67%. There's something called turnover ratio in a mutual fund. So they're constantly trading and there's costs associated with that. Those aren't always published. So the true cost of ownership of this fund was 2.43% and the advertised cost was 0.67. You know, I'm an advisor, so I am able to pull this data. You can too, but the thing is what mutual fund companies generally tell you is a lot less than what the actual cost of ownership end up being every year. So if we go back to personalfund.com, he's paying $15,057 a year for this fund. That's a quarter of his retirement goal. Insane. Again, going back to fees and risk, if you can eliminate a lot of these fees, you can create the retirement of your dreams. He could purchase a Fidelity healthcare index fund, and this is not me endorsing Fidelity, Vanguard. There's a Fidelity fund that's $1,129 a year to own, and also a Vanguard fund that's $1,150 a year to own, if he really wanted to stay exposed to the healthcare space. Now, why did this prospective client have so much money in healthcare? He was in the health field. So obviously he's got some bias around, healthcare companies. So if you wanted to own that, generally my rule is you don't want to allocate more than 5% to any one sector. So, they've got 1.4 million. 5% of that, he's okay having 70 grand in this fund. But outside of that, I wouldn't put don't put all your eggs in one basket. You've heard that saying. So that's a red flag. And so what we're going to do is we're going to jump back over to his portfolio and we're going to look at this and say, okay, well, let's make a few small changes. So I'm actually just going to fix what he's doing. So that's all I'm going to do. I'm going to take what he owns right now and I'm going to eliminate the boat anchors and we're going to keep the funds that are okay and remove some of these mutual funds. So we're going to get rid of all of the mutual funds, flip them out for index funds, and I'm going to verbally tell you what I'm doing. So we're looking at his total portfolio. We go over to edit. I'm just going to copy this and we're going to say, okay, overall, copy, let's optimize it. So let's fix his situation and he doesn't have to buy anything else. He's just going to sell out of a lot of his positions and rebalance into new ones. So his average rate of return was 7.83%. So let's go here and we are going to change out this fund for the Fidelity one. So FHLC. So plug that guy in. Now he owns a lot of things in here that I wouldn't recommend. We're going to take this value down. So we're going to go to weight. Let's drive that down to 5%. We can keep the money in money market. So some of these I'm going to lock the positions. He's got another mutual fund. Get rid of that one. So I'm getting rid of 1, 2, 3, 4, 5, 6. 6 mutual funds are dead in the water right now. That's good. We're going to lock all those guys. Why do I say get rid of mutual funds? Because you end up paying 90% or 92% of mutual funds have not outperformed index funds. So do you really want to bet against the 8% that have? And over a 20-year period, I'm sure that statistic will even go down further. But, get rid of what you can. Because you're generally with the mutual fund, you're overpaying for underperformance. I don't mind QQQ. That's a technology index fund. T-bills, those are okay. We're going to get rid of bonds. Why do I say get rid of bonds? Because when interest rates go up, bonds go down, and we don't know if inflation has totally leveled out yet, so we're going to get rid of those guys. International bonds, get rid of those. International stock we'll keep. And then we've got a couple ETFs down here. They hired an advisor and they only gave them like $400,000. And it's just because they didn't have total confidence. But honestly, out of the positions that they did have, the ones that the advisor purchased were the best, which goes to show why you should hire someone. So when we take this and we go in and we look at the new return, it's this is not what I would recommend their allocation be, but now their return jumped from 7% up to 9.37%, which is a 2% return. Now, I'm going to show you what I would do. So we're actually going to go through and we're going to build a portfolio, but I'm just saying I went in and changed a couple things with what he owned. I didn't even put anything new in there. I just reweighted, and we went for an index fund strategy rather than a mutual fund strategy. He's up 2% per year. So that's great. But he's still taking a little too much risk, in my opinion. So we're going to go through and we're going to level this out. So what we're going to do is we're going to build a portfolio for them that is representative of this $910,000 number. So we need to keep $910,000 safe and $490,000 in the stock market. By the way, let me show you the difference for Jim and Sally if they went with this portfolio versus the other one. So let's go back 10 years, and we're going to pull what they were doing before, and we'll do optimized. So let's just do 10 years. Their 10-year return, I was talking about 20-year returns before, but their 10-year returns before with all these mutual funds was 7.1% per year net of expenses. Their new portfolio per year, assuming they were paying an advisor the same amount, 1% per year, is 11.16%. Let's just do a value graph. For every $100,000 they put in, well, let's do their actual value. Let's do 1.4 million. If they gave the old advisor, when they put a little bit of money with them and they had a lot of money in mutual funds, over 10 years, if they put 1.4 million with the old plan, they'd have $2.7 million today, versus if they went with the new strategy, they would have $4,037,000, 1.3 million in their pocket. So, and this is just me tinkering around. Like, I haven't really dove into, the risk side of things. So the thing is, we don't always want to chase returns. Basically, what I was doing here is just showing you how to optimize for returns. But most of you listening right now, the goal isn't just growing your balance sheet. It's enjoying your balance sheet and taking money out every year. So how do we need to set up the portfolio if we want to take money out? So we need 490 that grows in the market, and we need 910,000 that's totally safe. Let's pick on the 490,000 first, and I'm going to show you generally what you could do, and I'm going to start putting in some new funds. So I went ahead and I created a portfolio for Jim and Sally. This is a very simple portfolio. Again, this is not a recommendation to buy these particular funds or stocks, but I'm just showing you generally what I would do. They've got 490,000. You want the base of that plan. 90% of money managers have not beat the S&P 500. And if you can't beat them, join them. And if anyone tells you differently, they have an ego. So we're going to take 50% of Jim and Sally's money that's in the stock market, that 490,000. We're going to buy the S&P 500, which is the top 500 stocks in the United States. It's replaced every quarter. If a company's not doing well, they get kicked out. If they're doing great, they get put in. Then we're going to buy 3 individual stocks that they believe in. So let's do this. We're going to buy Costco. We're going to put 10% of this 490,000 into Costco. We're going to put 10% in Apple, and we're going to put 10% into Microsoft. Now, why Costco, Apple, and Microsoft? Because pretend Jim and Sally, I talked to them. I was like, hey, where do you guys shop the most? They're like, we go to Costco all the time. I'm like, great. Is it packed out? They're like, yep. Okay, cool. Let's buy Costco. Buy where you shop. You have more conviction in the individual securities that you purchase if that's where you shop. Costco. It's like, what kind of phone do you have? iPhones. Great. Let's buy Apple. Microsoft. Now, they had, so in this case, we're going to pretend Jim is a techie and he loves technology, software, all those things. Asked about AI and the growth there. So we put 10% of that 490,000 into Microsoft. And then the last 2 positions, the next piece that got another 10% was Top T. Top T is an index fund that buys the top 20 stocks. In the United States, it's changed out every quarter. So the S&P 500 is the top 500 stocks. Top T is the top 20 stocks in the United States. It's a little bit more expensive for that fund, but still relatively inexpensive. And I'm going to show you what we're going to drive their fees down to in this scenario. And it's very much life-changing for them. And then the last fund that we're going to buy, so we're allocating their money in 6 different places. It doesn't have to be anything overly complex, is the Vanguard Total Stock Market Index Fund. So 10% goes into that one. So in total, we've got $490,000 split between 6 positions, 3 individual stocks, 3 funds that are buying a plethora of stocks that are on the open market. So here, I'm going to show fees of what they were paying before and fees of what they will pay in the new allocation. So here, let's say they paid an advisor 1% to buy this for them. So we're going to write after over on this side. And we're going to write before. So let's go to the after first. They're going to pay by using an index fund portfolio, they're going to pay 0.04% in funds expenses, and then they're going to pay an advisor 1%. So they're going to pay 1.04% all in. So let's do this math. 490,000 times 1.04. They're going to pay $5,096 a year before what they were paying in fees is 1% across the total portfolio, which I'm going to show you how we're going to eliminate the fees on this $910,000.
If retirement clarity matters to you, don't wait. Text BOOK to 864-920-3155 or click the link in the description below to get a free copy of Johnathan's book, Retire Right.
But they were paying 0.45% to the funds and 1% to the advisor. So, and we're not going to even include the total fund, the hidden cost of the mutual fund. We're just going to go over disclosed costs. So 1.4 million times 0.0145 is what they're paying. So before they were paying $20,300 in disclosed cost. Now, the after number that I gave you by using an index fund portfolio, there are no hidden costs in index funds, at least the ones that we source and use. Whereas the mutual funds, it's at a minimum, they're paying $20,300. I showed you that one fund was $15,000. So that would be an additional, $15,000 on top of this 20, by the way. So before they were paying $20,300 a year, now they're going down to $5,096. Now, why is that impactful for a retiree? Because their goal is $60,000 a year. They want to take money out. They want to enjoy it. By making this one change, you're getting back 25% of your income goal every year, which is astronomical. I mean, spread that over 10, 20 years. You're talking about hundreds and hundreds and hundreds of thousands of dollars back in your pocket. So then the next thing is risk. Well, what was the risk they were taking before? And then what's the new amount of risk? So we're going to go in here and we need to figure out what to do with this $910,000. So what do we do with this money? So before they had 76% of their money that was subject to risk. Oh, I wrote that in the wrong spot. That's okay. 76% that was subject to risk before. Now we're recommending that they only have 35% subject to risk. So what does that mean? That means that they are taking half the risk that they were previously. And I'm going to show you how they're not going to give up returns. So taking half the amount of risk. Now, why is that important in retirement? Because when you stop working, you're losing your ability to earn. Before, if you made a financial mistake, it's like, oh, no big deal. I can just go in and increase my 401k savings to make up for that financial mistake that I made. You're no longer working, so you're not getting a paycheck. And I know that no one watching this wants to be a Walmart greeter. So let's talk about how to create a plan where you don't have to become a Walmart greeter. That's what this is. So the risk side, this $910,000, they're annual income goal is $60,000. So how much do they need to keep in savings or in cash? I love cash. It is historically the worst performing asset class over the last 100 years. So even though I love cash, I love security, we still need to, not keep way too much money in cash. What I would do here is $60,000 is their goal. That's their goal of what they need every year. Let's just take $100,000 and put it into money market. Right now, that's yielding 4%. And a good, moral, sane, prudent advisor will not charge you to buy money market. I know we don't, but you need to ask your advisor if they're charging you by money market, because if you're making 4 and you're paying them 1, they're taking 25% of your return every year. So that's first off, you shouldn't be paying for money market. So we take this $910,000 allocation, we put $100,000 in money market, making 4%. The remaining $810,000, I'm going to show you a strategy for that. Now, again, this is not a recommendation. I'm just generally giving you some ideas. So what we're going to do is we're going to go over, and I'm going to show you a strategy that we use regularly for clients. Now, what this is essentially a market-based CD. So when the stock market goes up, you can make, when the S&P 500, the ones that we use, they track the S&P 500. When the S&P 500 goes up by 15%, your return is capped. The highest interest rate today is 10.5. So your interest rate that you can make is capped at 10.5. You may be thinking, Johnathan, why would I want to give up any of my return? Well, if the stock market goes down by 40 or 50%, you can't lose anything. Now, these strategies are extremely boring. They only make interest once a year. So, you track the S&P over 12 months. Stock market goes up by 12, you make 10.5. So let's say they put in $800,000 into that bucket. 800 goes to 880,000. And then that following year, let's say the stock market drops by 50 or 6%. When you make interest on these types of vehicles, which we're going to go into this a little bit deeper, the interest is credited to the principal. So you can't lose that either. So now, boom, my value is 880. I know I can never drop below 880, which is phenomenal. Here, what we're going to use, I'm going to write it beside it. It's called an FIA, fixed indexed annuity. Now, I just said annuity, and some of y'all are like, oh, Lord, help him. The annuities, typically, why they have a bad rap is because of the insurance companies, how they took advantage of people in the beginning. So, if your parents got an annuity, more than likely they got something called a single premium immediate annuity. And what that is you're giving an insurance company money for a guaranteed paycheck in the future. So it's like, okay, I'm going to give XYZ insurance company $100,000. They're going to pay me $10,000 a year until I die. Okay, let's say mom and dad got that, and then mom and dad did it in mom's name, and then whenever, let's say something happened to mom, tragically, that money in a single premium immediate annuity, if it was single life only, is gone. That money is gone, which is why annuities got a bad rap, because in the beginning, most annuities that were used were single premium immediate annuities. And also financial education wasn't as prevalent back then. So, you may have had some bad brokers in the mix who made it sound great, but that actually wasn't what it was. And, just as well as I do, is an insurance company going to side with, with them or with the client? Most of the time, them. They're not known as being, the most forthright companies in the world, especially in the beginning. So that was kind of the emergence of annuities. And then you fast forward to today, you have something called variable annuities. Those are expensive. They contain market risk. Well, finally, insurance companies in the late 90s started to implement something called a fixed indexed annuity. And to my knowledge, this is the best type of annuity that exists. I'm not crazy about any of the other ones, but these can work. A fixed indexed annuity is your principal is fixed. So if you put in $500,000, in Jim and Sally's case, $800,000, they put in $800,000, they cannot lose that money. Also, if something happens, let's say this annuity's in Jim's name, something happens to Jim, that money goes to Sally. Great. Okay, so that the money isn't poof, gone. The last part is annuity. It's offered by an insurance company, so that's what they call them. Every annuity contract has an option to do something called annuitizing the contract, which you would never want to do in this type of an annuity. It's basically going to operate like a market-based CD. Stock market goes up, I make 10.5. Stock market goes down, I can't lose anything. If the stock market goes up by 5%, I make 5. If it goes up by 10, I make 10. If it goes up by 11, I'm capped at 10.5. That's the most that you can make. There's a very long explanation. All to say that these vehicles average about 7% per year and they don't have any fees. Now, Johnathan, this sounds like an amazing product. What's the con? The con is you have early withdrawal penalties, just like you would have on a CD. If you take your money out early, the insurance company assesses a penalty. Generally, in the industry, they're 9% the first year, 8% the second year, 7% the third year. They go down every year, and you have access to 10% per year, no penalty. So everything negative about annuities in the past, the reason why we use these vehicles is we limit our clients' downside risk. They don't pay us any fees to manage them, and their goal is $60,000 a year. They're putting $800,000 in this vehicle, and they have access to be able to withdraw most of the ones that are out there. And not all fixed index annuities are made the same. You have to get these from the right person. Don't just go bebop out on the street after listening to this episode and be like, oh, God's gift to the earth was a fixed index annuity. Don't do that. You get this from the wrong person, it's going to screw up your plan. You get it from the right person, it can enhance your plan. $810,000, they have access to $80,000 per year as a penalty-free withdrawal, at least in the one that I would set up for them. So how much do they need to live off of? $60,000. How much they have access to? $80,000. Guess what they can do with this $490 that's in the stock market? Go for it. They can grow it. And they can invest like they're 40 years old when they're 65 years old, average household age, because they have $100,000 in money market in case of an emergency, $80,000 a year that they can draw from, and they can set up a monthly withdrawal. And then they've got their money growing in the stock market at $490. So what's the end result for Jim and Sally, Johnathan? So let's compare these two portfolios. Previously, so when we go in and we look at Jim and Sally, their old allocation would have produced a return over 20 years, or let's do 10 years, a 7.1% per year. When we look at the new allocation with the fixed index annuity, money in that index fund portfolio that we created together, the average return jumps up to 10.24%. And in 2022, when their portfolio that they had before dropped by 15, they only dropped by 7% in this new portfolio. They cut their fees from $20,000 a year down to $5,000 a year. They're taking half the risk, and they're generating nearly 50% more year over year, even though they hired a financial advisor. It's not rocket science. And if you're listening to this right now and you're like, oh my gosh, Johnathan, you covered so much in a short amount of time. It is, your retirement planning is intricate, but here's the thing. If you go and you talk to a contractor, and let's just say you show up to your site where your house is being built, and you talk to the subcontractor who's pouring the foundation, he's going to start talking about horizontal integration, vertical integration. How do you get all of this to work together to make sure your electrical can run through the foundation? And he's going to be talking about all these things. But at the end of the day, you have to look at this person and say, can I trust them? And as long as you can, then you can see how at least in our world, how your money is growing more and why you're taking less risk. And the reason why I love building a plan like this, that takes the best of both worlds. You take the best of the stock market, you take the best of insurance products, you commingle them together, and you create a plan that you don't have constant anxiety. We removed half the risk, and we're generating 50% more money. Now, over 10 years, in their old allocation, just for reference, if they put in $1.4 million, so this is blended between stock market and the annuity product. If you put in $1.4 million 10 years ago, you'd have $2.7 million in Jim's old portfolio. And it's because he was paying out the wazoo for mutual funds and all those things. Now, that's not that bad, right? You have 1.4, you turn it into 2.7. But what sounds better than 2.7 is 3.7 while taking half the risk. That is insane. You don't have nearly the ups and downs. If you're looking at this bar chart, if you're watching this on YouTube, there's a period here where the market goes down in 2022 and you don't experience nearly the same pain that you did in the old allocation. Now, here's the thing. You take this whole thing, this whole wrapper, and then you wrap around it a tax plan and a legacy plan. And you know exactly when you're going to take withdrawals, how much you're going to pay in taxes every year. And you, Sam, can I borrow that? Can you bring that into frame, the one-page plan? What you do is you want to narrow everything down. And if you're an avid DIY person at home and you're listening to this, again, this is not a recommendation to buy or sell security. But for us, I mean, you want a spreadsheet. You want something that you can put everything on one page and you know exactly how all these accounts are going to pay you over time, where the balances are allocated. And you know, this is how you, and you have 6-month touch points with a person and you go into how am I doing? How am I making progress? Do I need to make any changes? And you constantly address and review these things. And over time, this creates, this creates trips with your kids, with your grandkids, annual gifting at Christmas. We're right around the corner from Christmas. You're, you know, giving your kids a gift limit and you're gifting them stock. You're gifting them, you know, cash gifts. You're paying for colleges. You're doing all those things because you have an idea of how everything's going to work together. And you don't have to be sweating bullets at night if you see on CNBC that Jim Cramer says the stock market's down by 50%. So you have to use all these things in conjunction. And I think the traditional approach of retirement planning is when you find an advisor who's been in business for 40 years and they've done it the same way for 40 years. And a lot of people are like, oh, I have 40 years of experience. Most advisors who are very gray have 40 years of experience 1 year at a time. What you want is somebody who's open and they are willing to adapt to what the world is doing today. You know, we have Big Money's been in existence for 5 years. But the thing is, I constantly tell, when we get a new advisor on the team, I'm like, please rip my strategy to shreds. Like, please tell me everything negative about what it is, the way that I'm doing it. Like, I want to be critiqued and criticized. And I honestly value that in client relationships. I'm like, yeah, please tell me what you think could be done better. Because the day in this industry that you think you have it all figured out and, you know, I'm sticking to this one approach, I'm putting my clients' assets in this one strategy, you're done. I mean, you've got to use a lot of different things together. Today, we know the index funds work. Insurance companies, if the products are used correctly, can work phenomenally for retirement. But you need to make sure, like, when you implement something like this, advisors are paid. It doesn't come out of your pocket, but they're paid to implement these strategies. You need to know what they're paid. You need to say, hey, who are all the insurance companies that offer these products? They need to be independent, whichever advisor's implementing it. How much are you paid to do this? They should show you that on a sheet. And then when both of you are transparent, both the client and the advisor, and they know everything that's wanting to be accomplished, this is easy. It's simple. But only when you got the right person. So I hope you enjoyed today's episode of Build Big, Live Bigger. Today was tactical. It was fun. We're going to be doing more episodes like this. I really enjoyed going through the white paper. I believe we're definitely going to have a tax episode upcoming where we go through and I get Chris involved and we look at a tax situation for a client. But thanks for watching this episode of Build Big, Live Bigger. Oh my gosh. Thanks for watching this episode of Build Big, Live Bigger. And if you want more information like this, I literally wrote a book. It's called Retire Right. It's a short read, 150 pages, big print. I know our clients are 50 and older, so we made the print big for you. You can go through, read it. If you want to copy that book, text our office line. It's 864-920-3155. That's 864-920-3155. If you enjoyed this podcast episode, and your parent, you may be young listening to this and your parents are approaching retirement. You may be a client that's listening to this right now and your coworkers talking about how to retire. Send them this video and say, hey, this is something that helped me. But share the video. Don't be selfish. Don't keep it to yourself. And have a great day. if you're listening to this right now, you have a white belt mentality, which means it is day one. You are learning and you're improving. And I want to commend you for that, because very few people are listening to a podcast like this today. And that means you want to get better. You want to understand finances more, and you want to be the leader in your household as it pertains to retirement. And I just want to tell you that I'm proud of you. Keep doing what you're doing, and we'll see you on the next episode.